talk about what happens before gold bottoms, and given that, how to manage your portfolio as we go into 2019. Okay, so three things. I like to start off presentations by giving you the big points, the things that you need to remember. You obviously hear lots of presentations here. There's lots of material to digest, so I want to keep my main points simple for you. Not always, but it does happen that gold stocks often crash before a major bottom in the sector. And secondly, because of that, you need to consider using hedges and also raising cash. And thirdly, there's some trading rules that you can follow to help manage your portfolio as we move into the time before a major bottom in the sector, because we're not there yet as far as a major bottom. Okay, so before major bottoms, I wrote an article today about this, so I have 4 or 5 things here, 3 or 4 charts, I think. And these are the things that you tend to see happen in the sector before major bottoms. First, and this is very important, gold outperforms the stock market. And as you can see in this chart, looking back to the 2001 low and the 2008 low, there was what's called in technical analysis a positive divergence. So gold was outperforming the US stock market before gold bottomed in 2001 and 2008. You go back to 2008, the financial crisis low, gold against the stock market, that ratio bottomed before gold did at the end of October. And recently, the bottom that we had at the end of 2015, I mean, I don't know if you can call it a major bottom. I mean, it's really semantics. However, if we see gold against stocks, that ratio really did not confirm that as a major bottom. There was no positive divergence. And even worse, if we look at 2017, and I'm just going to use it. If we look right around here, we can see here, gold was trending up in 2017, but what happened? Gold against the stock market was actually trending down as gold recovered, after the big decline at the end of 2016. So that was a negative divergence, and it's playing out now with the weakness in the sector. So gold needs to outperform the stock market. There's only the only real bull market that gold had when it wasn't outperforming the stock market was 1985 through 87. And that's because there was a massive decline in the dollar. And even given that massive decline, it really wasn't that great of performance for precious metals. But still, it was a cyclical bull market. But that's the only time that we've had a bull market in precious metals where gold has not been outperforming the stock market. Last point here, gold is starting to outperform every other stock market in the world, just not the US stock market. So there is something positive going on in that. If you look at how gold's performing against global equities ex the US, that looks like it's bottomed. It's starting to trend up a little bit. So that's a good sign. But the real big thing we need is gold to outperform US stocks. That hasn't happened yet. Okay, we also need to see gold outperforming foreign currencies. This currency basket is basically, it's just the inverse of the US dollar. So we're plotting gold against the euro. I mean, a basket that's, we could say it's 2/3 the euro, maybe it's 20% the yen. There's a little bit of the pound in there and the Swiss franc. So it's mostly gold against the euro. But gold against this foreign currency basket, again, you look at 2001, 2008, gold was outperforming foreign currencies before the major bottoms in gold and in the sector. And interestingly, if we go back to 2017 again, we can see here, gold against the foreign currency basket, it's actually been making lower lows as gold was rising here. So that's not a good sign. That's another negative divergence. This low right here, I mean, this may end up holding. It's possible that this could be the low and gold against foreign currencies strengthens and performs better as gold drops some more. So that's something to look for. But as of right now, there's no positive divergence there. But like I said, maybe if we look back in 6 months, there will be. Okay, and this doesn't precede major bottoms, but it's important to mention. I mean, it's obvious. Major tops in the US dollar are going to coincide with major lows in gold, and a major top in the US dollar gives gold and precious metals the ability to have a bull market that lasts for several years. And 1985 and 2001 are the big peaks. The next peak, I don't know, maybe it'll be next year, maybe 2020. A lot of people have been talking about the possibility that gold and the dollar will go up together. I think it's very possible. Looking back at history, based on what I've looked at, gold tends to bottom 4 or 5 months before a peak in the dollar. But this time around, maybe it's different. Maybe they both go up together, and maybe gold's bottom is 12 months or 18 months or 15 months or 10 months before the dollar peaks. So it's still a very important inverse relationship, but keep in mind the possibility this time around that gold could bottom while the US dollar is still rising. Okay, and this has been true recently as far as recent decades, but not always. We tend to see a severe decline or even a crash in the gold stocks into these major lows. At the bottom, that's GDM, which is the parent index of the GDX ETF. And if you see those areas that I've highlighted, this lost 35% in the last 6 months, this 60%. Here, minus 40% in 6 months, although we did base for several months before we had that bottom. I mean, I'll talk about the technicals a little bit later, but so this is something to keep in mind, because if we see gold stocks starting to fall apart again and they look like they're crashing, that's obviously very negative, but the bright side of that is that has happened before, leading to major bottoms and fantastic buying opportunities. And this is something that I've been talking about for months and months. I even saw a quote today on Twitter. Stan Druckenmiller was saying something similar, where if the Fed reverses course and does QE again or cuts rates, that's when gold is going to really skyrocket. And so the Fed changing policy, it's not always the Fed ending their cuts. I mean, there are points, most specifically in the 70s, where there was a lot of inflation. The bottoms in the 70s tended to be when the Fed started hiking rates. But most of the time, looking back at rate cut cycles over the last 60 years, most of the time, it's really when the Fed stops hiking rates that you get a major low in gold. And so the timing, I looked at a lot of the data, and as you can see at the bottom, I said 1 to 2 months. I think the average time after the Fed's last hike, the average time is 1 month to the next low. The median is 2 months. So most of the time it was almost instantaneous, or 1 or 2 months. There was, I think, one time when it was 8 months and another time when it was 4 months. So I'm very, very confident that this is when we will see precious metals bottom, when the Fed ends its rate hikes. You know, maybe it'll be instantaneous, maybe it'll be a month or two after that. I don't know exactly from that point when the bottom will be, but that's the time when the tide will really be turning favorably bullish for precious metals. Okay, so let's talk about the gold stocks outlook right now. The outlook is not good. It's really shitty. I'm sorry to say, but this is really bearish. Here we have GDX at the top, we have GDXJ at the bottom, and what we can see is, so we were consolidating for most of all of 2017 into 2018, and in this line right here we saw, I mean, this is an impulsive move. It's a strong downward leg. Both GDX and GDXJ, they broke through. This was formerly support, so now it's resistance, and this is just textbook. After you have a sharp move down, this is a weak uptrend. This chart is from yesterday. This may have even broke this line today. But I mean, this is what I would call weak strength. And I mean, this is just textbook. You break a level, a lot of times you're going to come back and retest that level. So this is weak strength. This is a retest of that resistance. And I wouldn't be surprised in the next week or two if we see we see a strong break lower, and then this leg down kind of repeats itself. I mean, looking at GDXJ, I mean, even if you just measure from here down to here in this trading, I mean, that target's 22.5, this measured move. So this outlook is not good. It's really bad, and you need to raise cash and think about hedging, actually. And here, this is the advanced decline line, and the advanced decline line is really, it's a breadth indicator, so it tells you sector participation, how many stocks are going up versus going down. A market is strongest when breadth is strongest. So it's strongest when 95% or 100% of that market, 100% of those stocks are rising. That's when it's the strongest. And so that indicator, it's a leading indicator. So it tends to turn before the market itself. So it's really the holy grail of leading indicators. And so we have GDX here. You can see the 21. This was a key level. Now it's resistance, as I said in the last slide. Weak strength here. But what's happened to the advanced decline line? Even, we got this rally here over the last couple months, and this was just very weak here in the advanced decline line. And even in recent days, it's made a new low. It's broke to a new low well before GDX has. And so here's an example of the other side. When you go back to the end of 2015, early 2016, we can see here's GDX. It made a lower low here, but the advanced decline line made a higher low. And here as we got into the end of January and February, the advanced decline line was just surging right along with GDX. So that told us here, that this is a real healthy move. Here we're seeing the complete opposite. This is a really bad sign. Like I said, GDX very likely to break down here and go a lot lower. Okay, so speaking of hedges and trading rules, this shows we were in JDST. We caught the move over the summer. These are not exact, but these are times when we point. We bought JDST, which is 3 times short the juniors, the GDXJ ETF. So these were buys right here, and then as soon as we had this big move up, we sold here. We didn't sell at the top. We got back in again here, and the last couple days is starting to make another good move. So I think this has a chance to be even. This trade has a chance to be even more profitable than this one in the summer. Okay, so trading rules. Let's keep it really simple. Sell at a 20% loss. I mean, looking back, if I would have done this over the last 5, 6, 7, 8 years, I mean, I would have saved myself from bigger losses. If you think about it like this, if you have a 5% position and you cut it at a 20% loss, you're only risking 1% of your portfolio. So you can play around those numbers to see, maybe 15% or 10% suits you better, or maybe 30%, I don't know. But define your risk, and when the risk gets hit, get out of that position. Because what I find is most of the things that drop 20 or 25%, they tend to drop 40, 50, 60%. The only time this rule has not worked for me was I got stopped out of something at the end of 2015. So that's the only time it's not going to work, is when you buy right before a major low. And also trim your big winners. Consider selling, a third or a half. Again, figure out what works best for you. Maybe it's when you have a 100% gain. Maybe it's when you have a 50% gain or a 75% gain. Again, everybody's different, but if you're sitting there, holding on to, GBR or West Haven, and you have these massive gains, you should be taking some money off the table. That's how you can lower your risk quite a bit, and at the same time, you can still stay in that stock, and you can still make money if it continues to rise. And when you take money off the table, then if the stock goes down, you're not going to be hurt as much. And so the real key there is how big does a position get as far as a percentage of your portfolio. So if a position, it's moving up and it's number 1 on your list, and as a percentage of your portfolio, it gets to be, quite a bit bigger than number 2 or 3, that's when you need to trim that position. Okay, so 3 things you need to remember. Number 1, there's a crash risk in gold stocks over the coming months. Number 2, it's time to raise cash and buy hedges. And thirdly, as I've been saying for months, the bottom will be when the Fed hikes end. And everyone you can go to my website at thedailygold.com/premium MIF. I'm running a special I think $97 for 6 months, super affordable. You know, I'm going to help my subscribers raise cash and make money as these markets move to the downside. And that way, we're going to have a lot more money and a lot more cash when the Fed stops hiking, you know, in the second half of next year. And then we're going to use that cash to, you know, buy juniors and, you know, make a lot of money into 2020. So that's my presentation. And that being said, you don't need me to tell you that money is flowing into companies that are making discoveries, growing discoveries, adding value to economic deposits. Despite where metals prices are, despite this outlook, there are companies that are doing that, and that's where money is flowing into those areas. So I wouldn't, you know, per se sell everything that you have. Just focus on, you know, your favorites. Focus on your favorites, the stocks that really have a chance to make a discovery or add value to an existing discovery. I think those are the things that you want to hold moving forward. Because if they add more value, they have a good chance to increase in share price, even given the negative outlook for the sector. You know, I'm only holding, I think, 5 or 6 stocks right now. One of those names is up next, Triumph Gold. It's very inexpensive. The stock has come down, so it's much lower risk to get in right now. They've already made a discovery, but they have something even more exciting, the potential to make an even bigger discovery in their next drill program. And John Anderson is going to tell you about that.